Welcome back to another wonderful episode of launching your AI startup in under 28 days. My name is Yanni. I'm a growth partner here at Thinkk. I appreciate you being with us. Today, we're going to run through raising capital. In other words, going ahead and bringing on a whole bunch of money to either start or fund or fuel your idea. And so, this is one of our favorite chapters here because for a lot of huge companies, companies that want to be SpaceX's, companies that want to be Teslas, raising some capital is sometimes necessary. And so, before we even get into it, though, remember the source of our credibility. Firstly, on my side, I have over a decade of entrepreneurship experience, either launching, running, advising, or investing in different startups. And on Think's side, we advised over 45 different AI startups last year in 2024. And so everything that you're going to be learning here comes from data driven insights and real proven models. The first thing that we want to do here is run through maybe a whole bunch of different options for actually raising financing for your company and just go ahead and compare them so you have some sort of idea of where to look if you do eventually decide that you do want to raise some sort of venture capital or just capital generally speaking. So the first source of that is going to be venture capitalists, and this is going to be probably the most typical source of financing that any one startup founder might have heard of. And so, what venture capitalists are simply that they are people that invest capital into different new ventures. Really straightforward speaking. And typically, this money is not actually their own. In fact, they're typically managing partners who go ahead and manage a whole fund of other people's money. And then they pretty much just go ahead and invest it into a whole range of different early stage or different stage companies. And ideally, the goal of this whole operation is to generate a return on their capital for their investors. But obviously, even though VCs are the things that most people talk about and have been responsible for a ton of value creation in this country, you also have to recognize that VCs are not perfect. And um, we typically hear a lot of complaints from founders that are working with venture capitalists. And the reason is the VCs are not perfect. First of all, they take a lot of equity from you, which is the ownership that you go ahead and build. And they're really going to fight you on your valuation typically because they want to go ahead and make sure that they can exit at a higher valuation. So, in order to make a lot of money, they want to beat you down on your valuation, which isn't always a great thing for you as a founder. Um, they also really like to replace ownership in these companies. And so, in other words, if you are the CEO of a company or you have a founder in this company, typically what these VCs might want to do is they take board seats, they take ownership stakes, they do all these different things, and eventually try to remove whoever's running the company, basically just to go ahead and wiggle out whatever it is that they're actually building from those people. Then they go ahead and put their own people in there if they decided that the founder or somebody wasn't great, which on the one side is interesting for VCs, but keep in mind if you are a founder who put a lot of time and effort into going ahead and building something great, well, you're not going to really like being trying to be kicked out of your own company. And so remember this when you go ahead and bring a VC on board. Another thing you want to consider is the fact that for better or for worse, there are many people in venture capital organizations that have never once run a company before. And so they are typically going to be a lot of junior analysts and other people that are making decisions about companies that they don't understand and also have no basis in reality for thinking. And so, in other words, the most common path into venture capital is going to be a finance degree in undergrad until eventually you go into public markets and maybe you work at some investment firm, working with companies like Apple and this and that. And eventually, after working in private equities, you move over into I'm sorry, and eventually, after moving in from public equities, you eventually move into the private equities, which are going to be, companies like startups and other privately held firms. And so it's important to remember that not all these people actually have business experience. And so they might go ahead and tell you, hey, why don't you just go ahead and do XYZ without actually realizing how difficult it is to do XYZ because they've never really been in a founder's shoes or run a company. This is something that's really important to mention. The last thing is they do like to present you a whole bunch of term sheets and other things, which are typically pretty complicated. And so as a result, you are going to want to get a lawyer to review a lot of these things to make sure that these guys aren't trying to finesse you or basically wiggle you out of your company. In addition to venture capitalists, another very common source of funding for your early stage company is going to be angel investors. And I think we really like angel investors. And we typically have a lot of great experiences with them because angels are typically one off people who have had a lot of success in entrepreneurship themselves, typically within whatever niche it is that you're operating in, and now have the capital to go ahead and invest into new companies and actually serve as advisors and members of the team to go ahead and really build that firm up. And that's an amazing thing. And so you can think of angels as exactly that, little angels that come into your business and kind of help you succeed. They typically have very large personal networks. Again, they have a lot of experience of like, hey, I've been there and I've done that. And so all of those things are actually really, really critical and important to an early stage founder. And so this is another source of capital that you might want to consider. The third very traditional or classic fundraising sources or funding sources for your company is going to be friends and family. And in a book I read called How to Get Rich, which is actually a terrible title for a really great book. I believe it was a guy by the name of Felix Dennis or Dennis Felix. He basically talks about if you are willing to take money from the sharks, which are going to be your VCs and your angels, then you should also be willing to take money from fish, which are going to be less educated investors. And these people are typically going to be like your friends and family. This is an amazing source of capital because all these people believe in you and they do typically are going to be willing to give you some sort of capital. The thing to consider about this is, do you really want to turn your Thanksgiving lunch or your Thanksgiving dinner into a business meeting? Because unfortunately this can happen, and you want to be very, very careful mixing business and family because you never want to see money get in the way of blood. Okay, and this is just something to remember. So if you are going to take money from your family and friends, make sure that they can absolutely have the money to lose. And also make sure that you go ahead and actually make this into something that's official. Okay. Make sure that people are signing contracts and doing all these sort of things so that they know exactly what the terms are and that you're not going to end up risking some sort of relationship with somebody that's close to you, whether that's a father, a mother, an uncle, a brother, any sort of very close friends that you have that might want to invest in your company. So be very careful when you're doing this. But again, that's not the only place that you can go ahead and get capital. And we're going to cover a lot of those here. So I'm also going to cover two forms of capital you should absolutely not touch. And again, I'm covering this only so that you can make sure to avoid this at all costs. Because although people talk about it, it's pretty much one of the single dumbest things that you can do as a startup founder is go ahead and get a bank loan to get your company started. And I mean that fully. And in fact, if you are willing to do this, it definitely stands as a testament to how much risk you're willing to take on as a founder, but it also stands as a testament to the fact that you're not really analyzing your risk very well when it comes down to this, because everything comes down to risk reward. When you're taking on a bank loan to go ahead and build a startup, what you are basically doing is signing a lifelong poverty trap because all of these loans that you're going to be taking on are going to be personally guaranteed. Your startup typically doesn't have a lot of assets to put up as collateral against whatever loans you're taking. And your cash flow as a startup is all over the place. I mean, it is just like it is, some months is great and some months is not. And so you have to go ahead and consider this before you take on any sort of bank loans. In fact, what banks are typically looking for when they're loaning money out is a consistent return on that capital they get back. And so, if you are a small business or a medium sized business, or you've been in business for 6, 7 years, and you have a really good track record and you have some sort of expectations as to what sort of capital might actually come into the business over the next, 5 years, 10 years that you're going to be paying this loan back, at that point, is something to consider. But as an early stage startup founder, you should absolutely avoid bank loans at all costs. Most banks will not give you the loans if they have any sort of wit about them. And I'm telling you right now, avoid them. It's a terrible idea if you're an early stage startup founder. There's another place which is also an absolutely horrific idea. And I don't even know which one's worse, the credit card stacking and the credit lines or the actual bank loans for an early stage founder. But remember that, yes, in my own terms, this is startup suicide. In other words, what you sometimes hear about is people going ahead and taking out all these brand new credit cards, like a 0% APR for 18 months or something. And they'll do something called credit stacking. So they get the one credit card, and they go ahead and take out all this debt on this credit card, and they pay for all their startup expenses with it. And then in order to pay off that credit card, they go ahead and get a second credit card, and then they start paying off that one. And then in order to go ahead and pay off that credit card, they get a third credit card. And before you know it, you are pretty much just in so much freaking debt that there's just no way that you are ever going to make it out. And keep in mind, like as much as we try to build great companies here, like 90 something percent of companies are just not going to make it. And so if you really consider it in that terms, you pretty much, if you take any of the above two options, have a 90 something percent chance of just being in a lifelong poverty trap. And so I applaud your willingness and your ambition and your desire to go ahead and bring a lot of capital on board to build your business. But you have to be very, very careful about where you get that capital from because not all forms of capital are created equal. And if you end up taking bank loans or credit cards or credit lines or anything else, which are really meant for more sophisticated and established businesses, you are pretty much guaranteeing yourself a miserable life for the rest of your life. And so do not do it under any circumstances. There are two other forms here, which are actually really good forms of alternate financing for your startup. The first one is going to be crowdfunding. In other words, going ahead and using platforms like Indiegogo or GoFundMe to go ahead and get a whole bunch of capital on board from complete strangers, fish, again, as we like to call them, to go ahead and fund your company. And this is a really interesting way to do it. But in full transparency, this doesn't tend to work as well for all businesses. And the businesses that it does tend to work pretty well on are going to be physical products that have some sort of strange mass appeal. And so you can think of one of the best crowdfunding or crowdsourcing campaigns I ever saw was for a fork that twirled your own spaghetti for you. And so this is the sort of thing that people will see and say, "Oh, I could be interested in that, and let me go ahead and put a little money behind this." In other words, it really plays the culture. And so you have to understand this when you go ahead and do this. And I mention this because it might not be the best source of capital for an AI startup or something along those lines. Another great way to go ahead and raise capital for your business is going to be in the form of grants. And so grants are pretty much free money. They are money that the government, whether it's local or federal or some sort of organization, sets aside, typically to fund different initiatives. And so, in the startup space, what you might find is that some governments typically set aside capital that can be used by underrepresented individuals, whether that be minorities or anybody else, and actually go ahead and try to level the playing field. So sometimes governments will set aside, a couple $1 million or a couple $1 billion to fund, let's say, minority business ventures or women in entrepreneurship because of their underrepresentation. And so if you can get a grant, absolutely go and get it because it is pretty much just a loan that you don't have to pay back. It is free capital. You put it towards whatever you want, and again, you don't have to pay it back. So this is like the number one source of capital, if you can get it, is probably a grant. They don't take equity, they don't take anything. Um, and all they want to do is see you go ahead and succeed. And so obviously it's a little bit more nuanced than this, but if you can go ahead and get some grants on board, some people actually like to use grant writers or people that can, hire people to go ahead and get those grants. This tends to be a pretty good way to go about doing it. But this is not the only way to do it, right? We talked about all these different ways to go ahead and get startup funding, and we're actually going to talk about a couple more in a second here. But one of our favorite approaches is actually just not taking on any sort of funding from outside sources at all. And this is a form of financing called bootstrapping. In other words, just going ahead and pulling this up from the boots yourself. And this is a really, really good way to do it. And typically, my favorite way to do it for AI startups, because when you're typically building with code or something, you actually don't require a lot of capital to get started. And in fact, for most digital businesses, you don't. Think about content, think about courses, think about all these different things, your personal brand. You have an iPhone in your pocket, you can pretty much go ahead and get any of these things going. And so bootstrapping, or in other words, funding your own companies, is actually probably my favorite way to go about doing this. Again, it's not ideal for every single company. If you're trying to build a Tesla or a SpaceX, you require a lot of inventory to get started. You have some sort of physical products. You need a lot of money for development or something. At that point, you typically do need to go ahead and raise some capital. But if you can't afford to bootstrap, it's typically the best way to do it because you will go ahead and retain all of the ownership and all of the equity that you were going ahead and working for. In addition, you're going to make sure that you're not bringing in anybody else on board, which is going to complicate the process. You're not going to bring on VCs that might want to kick you out, and so on and so forth. So if you can go ahead and bootstrap, this is typically going to be the best way to do it for an early stage AI company. And keep in mind, the other thing to mention here is that most startups that actually are pursuing capital are simply not going to end up raising the capital, either because the opportunity isn't there, or because they don't reach out to enough people, or because maybe the economy isn't good or something else. And so typically the estimates are actually upwards of 80% of the companies that do prefer or that do pursue startup funding are actually not going to end up raising it. And so as a result, if you do pursue startup funding, you may very well end up just creating a roadblock for yourself rather than a stepping stone for your success. Bootstrapping your company gets you around that. So as long as you have some company, some capital on the side, as long as you can just make sure that you can dedicate a little bit of time to going ahead and building this, and have very careful cash management, and are willing to lose your own money, this is typically the best way to go ahead and launch your AI startup. But there are a few other ways. Again, if you want to avoid the bootstrapping approach altogether, it's going ahead and actually getting your startup funding going. One of which is actually going to be other businesses. And so you can imagine that if you were building a business, which is going to be super, super beneficial for like one entity or a person or a business or something else, you can actually ask them to go ahead and fund your idea or fund your venture. And as long as you structure this well, to make sure that they don't go ahead and steal your idea, there are a lot of companies or managers within those firms that would say, well, I can go ahead and hire an entire team. I can go ahead and do all these different things and manage the project and allocate all these resources to this. Or I can just go ahead and give you a little bit of money. You already have the team, you already have the expertise, and then we can form some sort of profitable business collaboration relationship afterwards, where we can go ahead and actually use that product at a discounted rate or something. So a lot of times you might actually find other businesses that are willing to fund your ventures for you. One of my favorite ways to actually fund companies, though, actually comes from your employees. In other words, people that you bring on board to the team. And although nobody talks about this as a great form of capital financing, I can promise you this is one of the best ways to do it. And the reason becomes that when you're going ahead and trying to raise capital from any sort of investors, a bank, venture capitalists, angels, anybody else, even other businesses, everybody is going to argue with you about what your valuation is. And in fact, they typically are going to try to beat your valuation down. But one of the things that you find is that the people internal to your business typically think it's actually worth more than what everybody else thinks it's worth, right? And they have a very good idea of what's involved in the business and what the prospects are for that business. And so being able to actually raise capital from your employees is one of the best ways to go ahead and actually raise a lot of it. Number one. Number two, give them additional ownership in the thing that they're building, which they really actually do enjoy. Um, and in addition to that, actually mitigate what we call the reporting costs. So, in other words, when you go ahead and bring a VC on board, you're going to spend a lot of time each week or each month going ahead and compiling reports and getting on phone calls and doing all these things to tell your investors how your business is doing and what you're up to. And these reporting costs actually take a lot of time and effort away from actually building your business. And so, what happens is when you go ahead and raise from your employees or other people that are on your team, you no longer need to do that. They already are very well aware of exactly what's going on. And so you don't need to set time aside with them to say, like, hey, here's what we're doing, because they're actually very involved in the company's growth. When you do decide to go ahead and raise, there's a few things to keep in mind. And these are really important to make sure that you raise with the long term intentions of your company. The first thing is, our best advice is probably to go ahead and just delay your raise. In other words, if you can afford to wait another 6 months, or if you can afford to wait another year, you should typically go ahead and do that, because what it will allow you to do is go ahead and build more traction. It'll let you get more cash flow in the door. It'll let you get more customers in the door, which eventually will down trickle into your valuation. And then it means that when you do eventually go ahead and try to raise capital, what it's going to mean is that you're going to end up giving out a lot less equity in your business for the same amount of capital. And so let's say that you were to raise capital today when your company's doing $100,000 in sales. Well, you might end up giving out like 10% of your company or something. If you wait, let's say a year from now, and your company's doing $1 million in sales, well, you're either going to end up giving out less for the same amount of money, or you're going to raise a lot more money for the same amount of equity that you want to give out. So generally speaking, if you do have a cash flowing profitable business, the best thing that you can do is just delay the heck out of the financing. You don't necessarily need it right now. And the longer you delay, the more equity you're going to hold on to as a founder, which is really important, because remember, that's what we work for. Another thing that we typically recommend here is raise a little bit more than you need, or that you think you need. So if you think you need about $1 million, go ahead and say that you need 1.2, 1.4, 1.5. And the reason why we do this is because sometimes you might be a little bit overly optimistic about how fast your company might end up growing, or you might have unfortunate roadblocks or setbacks, which you don't exactly have priced into your models. So it's important to go ahead and just raise a little bit more than you need to, just to make sure that you can cover all the basics. The last thing that you want to do here too is, although you are raising capital, you do want to consider every aspect outside of the capital in this equation as well. And what we mean by that is, even if you're raising from a venture capital organization, or even if you're raising from angel investors, you want to consider more than the money. You want to consider the networks. You want to consider the people that they've worked with in the past. You want to consider the doors they can open for you. You want to consider how founder friendly they are. And I really mean founder friendly, because every VC is going to say they're founder friendly, but like, are they genuinely going to be there for you through thick and thin? Or are they just trying to get a quick return on their capital? Because there are two different types of investors, and you really want to make sure that you're working with people that are going to be there for you long term, and not just try to get a quick buck on whatever it is that you're building. So when you do decide that you want to go ahead and raise the capital, you're going to need to get a few things together, as a general word of mouth, or as a general concept. First thing you're going to need is a pitch deck. In other words, a bunch of slides that pretty much outline the problem that you're solving, the solution that you're putting forth to actually solve that problem, any sort of traction that you've gotten in the last little bit. In other words, like things that are going well, and the momentum that you're building, and also typically like what you're asking for. In other words, like what sort of capital are you asking for, and what are you willing to give up in order to get that capital? So you really do need a good pitch deck, because the pitch deck is a thing that you're going to go ahead and submit to all these different investors, kind of inform them about your business and maybe 10 or 15 slides. You don't want to make this too complicated either. Another thing you want to do is go ahead and have a copy of your current financials. So, like, what is your company actually generating today? But it's not enough to just have your current financials. You also typically want to have financial projections. So, not only like what are you making today, but what could you see yourself making in, let's say, 2 or 3 or 4 or 5 years? And even though everybody knows that this is impossible to go ahead and forecast, for some reason everybody still wants it. So make sure you go ahead and actually get this stuff together. Another thing that you want to go ahead and do is just maybe put together some KPIs or some key metrics that an investor might want to look at within your company, because you are going to know your company better. And so if there are certain KPIs or performance indicators that you believe are vital to your company's growth and success, you do want to go ahead and relay that to your investors so that they know what to look for as well. There's two other things that you're typically going to need when you're raising capital for your business, or when you're preparing to go ahead and raise capital for your AI startup. And what this is going to look like is fairly simple. But first one's going to be a use of funds statement. And typically, what this is going to look like is a very detailed document which says, "Hey, I'm looking to raise $1 million. I want to put 280,000 into XYZ. I want to put another 140 into ABC, and so on and so forth." And so investors want to know where the capital is going. They're not just saying, "Hey, Tom, Dick, and Harry, go ahead and take $5 million and just do whatever the hell you want with it." No, they want to know exactly where that capital is going, and for good reason. You got to be able to track this stuff. So use of fund statement is really critical. And in addition to that, you also want cap tables and ownership structures. In other words, VCs want to know who owns what, if you've had any sort of past fundraising rounds, or who else owns equity in these companies. Because if they do, for example, get involved in a company where there is like really large ownership from one or two people, could actually serve as a risk for them. So they do want to go ahead and get all this stuff together. If you have any questions about raising capital, about fundraising, about venture capital, about angel investors, about what it's like to bootstrap your company, um, you know where to find us. If you need a fundraising strategy, if you want to go ahead and get an investor list together, go ahead and book a one-on-one workshop with me. I will go ahead and do this one with you, because fundraising is one of my favorite topics. And so if you do want to learn more about this, go ahead and get something booked. I'll leave a link in the description or somewhere else that you can do this. But in addition to that, I'm also going to leave a few other educational materials that you can go ahead and sign up for, to go ahead and make sure that you are continuing to learn and continuing to gain education around launching your AI startup in a very short period of time at no additional cost to you. And so if you need anything else about this, you know where to find us. Once again, I really appreciate you taking the time. It's a really, really fun topic to talk about. And I appreciate you just taking the willingness to go ahead and learn from us in this. So thank you so much. I'll see you in the next one. Bye-bye.